Central banks bought 863 tons of gold in 2025. Not 400 tons, not the historical average of 450 tons. 863 tons. At an average price above $5,000 per ounce, meaning central banks spent approximately $140 billion purchasing an asset that produces no yield, pays no dividend, and generates no cash flow, while their own government bonds were offering 4% to 5% returns. Let that number sit for a moment, because if you don't understand why the world's most sophisticated financial institutions, the ones that manage $12 trillion in foreign exchange reserves, would spend $140 billion on a non-yielding asset during a year when they could have earned $5.6 billion annually by simply buying their own government bonds, you are going to make the wrong decision about what comes next. What he has learned after 40 years of watching central bank reserve allocation is that these institutions do not make $140 billion decisions based on emotion. They make them based on mathematics. And the mathematics that drove 863 tons of gold purchases in 2025 is the same mathematics that is about to force every retail investor, every pension fund, and every dollar-denominated savings account to confront a reality that most people believe is impossible. But the real story isn't that central banks bought gold. The real story is what they know that the public doesn't, what the buying pattern reveals about where we are in the reserve currency cycle, and why the institutions that bought at $5,200 per ounce have not slowed their purchasing despite gold falling to $4,551 in March 2026. What he observed in 4 decades of analyzing sovereign wealth management and reserve currency transitions is something every person who owns dollars, stocks, bonds, or a retirement account needs to understand before this window closes. Subscribe now. Here is exactly what happened in 2025 and what it reveals about what central banks know that markets have not priced in yet. The number you need to understand is not 863 tons. The number you need to understand is 3. That is how many consecutive years central banks have purchased gold at more than double the historical average. 1,037 tons in 2023. 1,045 tons in 2024. 863 tons in 2025. 3 years. 2,047 tons total, at an average price that rose every single year. Let me say that more precisely because most investors have never been taught what this pattern means. Central banks did not buy gold when it was cheap at $1,800 in 2022. They bought it at $2,100 in 2023, $2,400 in 2024, and $5,200 in 2025. The higher the price went, the more aggressively they bought. That is not value investing. That is strategic repositioning. And in 40 years of watching reserve managers operate, he has never seen strategic repositioning of this scale happen for any reason other than one. The managers concluded that the current reserve currency system is approaching a structural inflection point. Here's where things get important. When a central bank buys gold, it is making a decision about what it does not want to hold. For every ton of gold purchased, a central bank is implicitly saying, we prefer this non-yielding metal to dollar-denominated treasury bonds that pay 4% annually. The opportunity cost of that decision in 2025 was $5.6 billion in foregone interest income on the $140 billion spent on gold. Central banks made that decision anyway. Not one bank, not 5 banks. According to the World Gold Council, 76% of global central bank reserve managers either increased or maintained their gold allocations in 2025. That is not a coincidence. That is a consensus. And here is what he watches most carefully. The buying did not stop when gold spiked to $5,589 in January 2026. It did not stop when gold crashed 18.5% to $4,551 in March 2026. The World Gold Council's Q1 2026 data, released in April, showed central bank net purchases remained elevated at 221 tons despite the price volatility. The institutions that were buying at $5,200 continued buying at $4,500. That is the signal. Not what they say in their annual reports, what they do with their reserve allocation when the price moves against them. Now let me tell you who was buying and why the specific countries matter more than the total tonnage. Layer 1, the de-dollarization buyers. China, Russia, and Poland have been the most aggressive purchasers over the 3-year period. China does not officially report its gold reserves in real time, but independent analysis of import data and refinery flows suggests China added between 300 and 400 tons to official reserves in 2025 alone, separate from what Chinese institutional investors in the private sector purchased. Russia, under comprehensive Western sanctions since 2022, has explicitly stated that gold purchases are part of a strategy to insulate its reserve base from assets that can be frozen, confiscated, or devalued through foreign policy decisions. Russia added approximately 150 tons in 2025, despite being cut off from dollar-based settlement systems. Poland, a NATO member and European Union participant, increased its gold reserves by 90 tons in 2024 and continued purchasing in 2025. Poland is not under sanctions. Poland is not isolated from Western financial systems. Poland is diversifying away from euros and dollars into gold because its central bank has concluded that the geopolitical risk of holding reserves in currencies that can be weaponized has risen beyond acceptable thresholds. Layer 2, the Gulf sovereign wealth repositioning. What happened quietly in 2025 and accelerated dramatically in early 2026 was a shift in how Gulf sovereign wealth funds, Saudi Arabia, UAE, Kuwait, Qatar, view their dollar exposure. These countries built their wealth on the petrodollar system. They recycled oil revenues into U.S. treasuries for 50 years. That recycling is what gave the United States the ability to borrow at lower rates than any other government on earth. And in 2025, those same Gulf states reduced their treasury holdings by an estimated $120 billion, while increasing gold reserves and alternative currency exposure. The trigger was not economic, it was strategic. The Gulf states watched Russia's $300 billion in foreign reserves get frozen in 2022. They watched the United States weaponize the dollar through the SWIFT system, and they concluded that holding 70% to 80% of their sovereign wealth in an asset that a foreign government can freeze is not risk management, it is strategic vulnerability. When the Iran war began in February 2026 and Saudi airports were bombed by a conflict launched by their American protector, that vulnerability became undeniable. The Financial Times reported on March 5, 2026, that 3 of the 4 largest Gulf economies were reviewing whether to invoke force majeure clauses in existing U.S. investment commitments. Gold purchases by Gulf central banks in Q1 2026 spiked to the highest quarterly level since 2011, not because gold was performing well. Gold was crashing. They bought because the cost of not diversifying, the risk of holding reserves that can be frozen or devalued by decisions made in Washington, had become greater than the opportunity cost of holding a non-yielding asset. Layer 3, the Asian reserve diversification. Singapore, India, Thailand, and the Philippines all increased gold reserves in 2025. These are not sanctioned states. These are U.S. allies or neutral trading partners. They are not buying gold to protest American foreign policy. They are buying gold because the mathematics of holding dollar reserves against a $36.2 trillion U.S. debt load, $1.03 trillion in annual interest payments, and a Federal Reserve that has been running losses for 3 consecutive years no longer supports the assumption that the dollar is a risk-free store of value. Singapore's central bank explicitly stated in its 2025 annual report that gold allocation was increased as part of a strategy to enhance portfolio resilience against tail risk scenarios in the global monetary system. That is central bank language for, we think there is a non-negligible probability that the current system breaks, and we are positioning accordingly. Now here is the part that almost nobody in Western financial media is explaining clearly. The 863 tons purchased in 2025 were not bought on the open market the way a retail investor buys a gold ETF. Central banks do not call a broker and place an order. They negotiate directly with other central banks, with the Bank for International Settlements, and with large bullion banks in transactions that are structured to avoid moving the spot price. The mechanism works like this. When Poland's central bank decided to add 90 tons to reserves in 2024, that transaction was negotiated months in advance through the BIS in Basel. The gold never touched a public exchange. It moved from allocated storage in London to allocated storage in Warsaw through a paper transfer of ownership. The COMEX futures market, where retail investors watch the price tick by tick, never saw those 90 tons. The Shanghai Gold Exchange never processed that volume. The transaction happened in what institutional traders call the over-the-counter physical market, a parallel system where sovereign entities trade in size without disturbing the paper price. This creates a structural disconnect that he has watched widen dramatically since 2023. Retail investors are watching a price determined by paper contracts trading on margin in New York and Shanghai. Central banks are transacting in physical metal at negotiated prices that often include premiums to spot. When you read that central banks bought 863 tons in 2025, what you are reading is the volume that moved in the physical institutional market. What you are not seeing is the price at which those transactions actually settled, because those prices are not published in real time the way COMEX futures are. When a central bank buys 50 tons of gold, that transaction is settled through allocated accounts, warehouse receipts, and bilateral agreements that keep the metal off the public exchanges. The price you see on your screen, the spot price that crashed from $5,589 to $4,551, is the paper market price. It is the price determined by futures contracts, ETF flows, and algorithmic trading. The physical market, where central banks operate, is different. In 2025, physical gold traded at premiums to the paper spot price in Shanghai, Mumbai, and Singapore for 87% of the year. When the paper price crashed in March 2026, the premium in Shanghai expanded to $8 per ounce. What does that tell you? It tells you that the institutions buying physical gold, central banks, sovereign wealth funds, large family offices, are operating in a different market than the retail investors trading GLD and SLV. And in 40 years of watching these two markets interact, he has never seen them remain separated indefinitely. Let me now tell you what the institutional price targets are and why they matter more than the spot price volatility. JP Morgan's Commodities Research Desk published a $6,300 per ounce price target for gold by the end of 2026. That target was issued in January 2026 when gold was at $5,400. Gold then crashed to $4,551 in March. JP Morgan did not revise the target. Deutsche Bank maintains a $6,000 per ounce year-end 2026 target. Goldman Sachs revised their target upward in February 2026 to $6,100 despite the Iran war driving short-term volatility. These are not retail analysts publishing speculative forecasts to generate clicks. These are the research desks that advise sovereign wealth funds, pension funds, and central banks on reserve allocation. When they publish a target and do not revise it despite an 18.5% crash, that is a signal. What are they seeing that retail investors are not? They are seeing the same thing central banks saw when they spent $140 billion on gold in 2025. They are seeing the mathematics of the U.S. debt trajectory. The United States is rolling over $9.2 trillion in maturing federal debt this fiscal year. At current interest rates of 3.5% to 4.25%, the annual interest cost on that debt is over $1 trillion. That is the first time in American history that interest payments have exceeded the entire defense budget. If rates stay at 4.25%, which is where the 10-year Treasury yield is trading as of March 2026, the cost of servicing $36.2 trillion in total debt is approximately $1.54 trillion annually. U.S. federal tax revenue in fiscal year 2025 was $4.9 trillion. Meaning 31.4% of all tax revenue is now required just to pay interest on existing debt before a single dollar is spent on defense, healthcare, infrastructure, or any government program. That arithmetic is not sustainable indefinitely. And the moment the bond market concludes that the only way the U.S. government can continue servicing its debt is through monetary debasement, through the Federal Reserve creating new dollars to buy treasury bonds that the market will not absorb at current yields, the value of every dollar-denominated asset, stocks, bonds, cash savings, declines in real purchasing power terms. Gold is the asset that benefits when that conclusion is reached, not because gold goes up, because the purchasing power of the dollar goes down. And central banks, which manage $12 trillion in reserves and employ economists who understand debt to GDP trajectories better than anyone on CNBC, reached that conclusion in 2023. That is when the buying accelerated to double the historical average, and they have not stopped. Here is what he knows about the two types of investors and how they respond to this information. One type of investor looks at central banks buying 863 tons of gold at $5,200 per ounce, and then watches gold crash to $4,551 and concludes the central banks were wrong. Gold fell, therefore the thesis is broken. They sell, they lock in losses, they move on. The other type of investor looks at the same data and reaches a different conclusion. Central banks bought 863 tons in 2025 at an average price above $5,000. Gold crashed 18.5% in March 2026, and the Q1 2026 data showed central bank buying remained elevated at 221 tons. The institutions that were buying at $5,200 continued buying at $4,500. That investor asks a different question. Not whether gold went up or down in the last 6 weeks, whether the structural conditions that drove central banks to spend $140 billion on a non-yielding asset have changed. Have U.S. debt levels declined? No. Debt increased from $34.8 trillion in January 2025 to $36.2 trillion in March 2026. Have interest payments become more affordable? No. Annual interest costs crossed $1 trillion for the first time in history. Has the Federal Reserve stopped running losses on its balance sheet? No. The Fed's cumulative loss stands at $245 billion as of March 2026, up from $211 billion in December 2025. Have central banks stopped buying gold? No. Q1 2026 net purchases were 221 tons, maintaining the elevated pace of the prior 3 years. The structural conditions have not changed. They have intensified. The price has changed. Those two things are different. What he has observed in 40 years is that the investors who understand the difference between price and structure, between short-term volatility and long-term arithmetic, are the ones who do not sell at $4,551 after central banks just demonstrated that they are willing to buy at $5,200. Let me close with the scenario analysis and what the probabilities suggest happens next. Scenario 1, the U.S. fiscal trajectory stabilizes. Debt to GDP declines. Interest payments fall as a percentage of revenue. The bond market regains confidence in dollar-denominated assets. In this scenario, central banks slow their gold purchases and potentially begin reallocating back into treasuries. He assigns this scenario a probability of less than 10%. The arithmetic does not support it. The U.S. is running structural deficits of $1.8 to $2 trillion annually with no political consensus for either cutting spending or raising taxes. The debt trajectory is not stabilizing. It is accelerating. Scenario 2, the current trajectory continues. Debt rises. Interest costs rise. The Federal Reserve is eventually forced to choose between allowing bond yields to rise further, which makes the debt unsustainable, or intervening in the bond market through yield curve control or renewed quantitative easing. In this scenario, central banks continue buying gold at elevated levels, and the J.P. Morgan $6,300 target, the Deutsche Bank $6,000 target, and the Goldman Sachs $6,100 target are all reached or exceeded by the end of 2026. He assigns this scenario a probability of 60% to 70%. It is the scenario most consistent with the last 3 years of central bank behavior and the mathematical reality of the debt service burden. Scenario 3, a fiscal crisis forces an acute monetary response. A treasury auction fails. A debt ceiling standoff triggers a technical default. A recession causes tax revenues to collapse while spending rises. In this scenario, the Federal Reserve is forced to intervene dramatically, and gold reprices not to $6,300, but significantly higher as the market concludes that monetary debasement is not theoretical, but operational. He assigns this scenario a probability of 15% to 20%. It is not the base case, but it is not negligible. And the cost of being unprotected in this scenario is catastrophic for dollar-denominated portfolios. The market scorecard as of April 2026 confirms the pattern. Gold is trading at $4,800 after recovering partially from the March lows. Central bank buying in Q1 2026 was 221 tons. The Shanghai premium to London spot prices remains elevated at $4 to $6 per ounce. JP Morgan's $6,300 target is unchanged. Deutsche Bank's $6,000 target is unchanged. And the most important signal, the one he watches more carefully than any price chart, is this. The central banks that bought 863 tons in 2025 at an average price above $5,000 per ounce have not stopped buying despite gold falling 18.5% in March 2026. That is not a bullish signal. That is a structural signal. The institutions that manage $12 trillion in global reserves have concluded that the risk of holding dollar-denominated assets outweighs the opportunity cost of holding non-yielding gold. And they reached that conclusion before the Iran war, before the March crash, before any of the headlines that retail investors are reacting to today. This was not a story about central bank gold buying. It was not a story about the 863 tons purchased in 2025. It was a story about what those purchases reveal. That the world's most sophisticated reserve managers, the ones who employ PhDs in mathematics and have access to fiscal data the public will not see for years, have looked at the U.S. debt trajectory and concluded that the probability of monetary debasement is high enough to justify spending $140 billion on an asset that pays no yield. The paper price crashed in March. The structural buying continued in Q1. And in 40 years of analyzing sovereign reserve allocation decisions, he has never seen those two things remain separated for long. Most investors don't know what 863 tons of central bank gold purchases in a single year means for the dollar, for bonds, for the monetary system they assume is permanent. Now you do.